Is Nvidia, ticker symbol NVDA, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Nvidia using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Nvidia is really worth in today's stock market. Plus, I'll share a special bonus that could be the deciding safety factor when adding Nvidia stock to your portfolio. Right now, Nvidia trades for $123.43 per share. In the last day of trading alone, it's down 0.45%. Nvidia is the most hyped stock in the market and the second best performer since June of 2023. In this time, its stock price is up 192%. It's been leading the charge in the S&P 500, which is up 26% at the same time. In the last 5 years, Nvidia is compounding at an insane 99% compounded annual growth rate. In the last 10 years, it's still insane. Nvidia is compounding at 75.8% annually. The company's stock price is up more than 200 times in just the last decade. When we go back before the global financial crisis, Nvidia is the top performing stock in the S&P 500. They've compounded at 38.5% annually. For much of this chart, you can't even see their stock price, and the S&P 500 looks like a flat line. Still, they do trade $17 below their 52-week high, but they are up 4 times from their 52-week lows. Right now, there are just 6 super investors who own Nvidia. The biggest name here is David Tepper, who has 6% of his portfolio in the company. Tepper's had an amazing investment in Nvidia, more than quadrupling his money in just the last year and a half. Starting with metric number 1, we want Nvidia's average returns on capital to be greater than 14%. Return on capital tells us how much value a company is creating. Think of it like your form when you're lifting weights. You want great form before you start adding on more weight through growth. Nvidia is an asset-light company that's earned high returns in each of the last 5 years. With AI-fueled growth that's driven high demand and low supply in the semiconductor market, Nvidia's return on capital numbers shot through the roof in 2024. Nvidia earned 60% returns on capital in that year, and in their last 12 months, they've earned 78% returns. These supernormal returns are because of that constrained supply. Semiconductors are cyclical in nature and they have boom and bust cycles. Just look what happened during the dot-com bubble. As other companies are racing to add supply to this market, we'll see if these high returns can last. Overall, Nvidia earns 28% returns on capital in a given year over this time. That's double our benchmark, and it's a huge check on metric number 1. So what does Nvidia really do? Nvidia is a leading developer of graphics processing units. Traditionally, GPUs were used to enhance the experience on computing platforms, most notably in gaming applications on PCs. GPU use cases have since emerged as important semiconductors used in artificial intelligence. Nvidia not only offers AI GPUs, but also a software platform, CUDA, which is used for AI model development and training. Nvidia is also expanding its data center networking solutions, helping to tie GPUs together to handle complex workloads. Next, in our second metric, with high returns, we want growth in their sales, earnings, and free cash flows. All 3 of these numbers for Nvidia are through the roof. In the last 5 years until today, their sales are up more than 7 times, their earnings are up more than 15 times, and their free cash flows have improved by 9 times. That's insanely fast growth for any size company, especially one that was already established like Nvidia. Given current high expectations, this growth would need to continue, and that may be very difficult for the business, but it's still a massive check on our second metric. Next, we want to look at Nvidia like an individual shareholder. In metric number 3, we want to see earnings per share growth. It's great a company can grow, but we don't want them to be diluting shareholders and have it come at shareholders' expense. Thankfully for Nvidia, that's not the case. We learned they grew their earnings by a huge amount in the last 5 years, and they've just had very slight shareholder dilution. Much of this coming for share-based compensation. While that's not ideal, it's not uncommon in the tech industry. So Nvidia has still grown their earnings per share at a very high rate. In fact, in their last 12 months, not shown here, they bring in $1.71 for each share they have outstanding. It's a check on our third metric, and Nvidia is perfect so far. Metric number 4 is similar but even more important. In it, we want free cash flow per share growth. Their cash flows again have grown by a staggering amount that's just slightly lower than their earnings. Still, in their last 12 months, they're up from 18 cents a share in 2020 to $1.09 a share in 2024. In their last 12 months, they brought in $1.59 per share. That's more massive growth, and it's another check. Nvidia is 4 for 4 so far. Now, why don't we dive into their dividends before we check out their balance sheet? Right now, Nvidia pays just a marginal 0.01% dividend yield. That's barely anything to write home about, but we still want to make sure this is supported by their cash flows. For Nvidia shareholders, they've easily covered their dividends in each of the last 5 years. This means almost all their cash flows are reinvested back in the company. Their dividends are covered over this time and today, which is what we wanted. This means it's a check on our dividend bonus. Next, in metric number 5, wonderful companies can earn high returns, grow, and don't need to use a lot of debt. Nvidia is no different. We want their debt to be lower than the sum of their cash flows, and in all 5 of these years, Nvidia has had a net cash position. This means they have cash left over after paying their debts. The company started 2024 with $15 billion in net cash. Today, this has grown to over $20 billion. Plus, in the last 5 years, they brought in $83 billion of free cash flow. This is a huge amount that means the business has a fortress balance sheet with high cash generation. It's exactly what we wanted, and it's another check on metric number 5. Now it's time to cover our key safety metric before we figure out how much Nvidia is worth. Ben Graham was the father of value investing and was Warren Buffett's teacher. He wanted to see a current ratio greater than 1.5 times. This is a key safety metric of short-term liquidity for how a company can pay its bills in a hurry. Nvidia today and in the last 5 years maintains a very high current ratio. Their current assets were 4 times their current liabilities to start 2024. Today, they're still coming in at 3.5 times, way above the benchmark we wanted. Today, Nvidia's balance sheet is very healthy. This is another check on our safety bonus, and now it's time to try to figure out what Nvidia is worth. The big metric of them all, metric number 6, is also today's first valuation. We want Nvidia's average cash flows divided by their enterprise value to give us a yield greater than 5%. This is in line with the historical yield from the S&P 500, and it would give a risk premium to the 10-year treasury. Today, Nvidia has more than a $3 trillion market cap, and in an average year over this time, they bring in $16.6 billion of cash flow. When that's divided by their enterprise value, we get just a 0.5% average free cash flow yield. But their historical numbers aren't the reason people are excited about Nvidia. It's because the company's been growing by leaps and bounds amid AI hype. In their last 12 months, Nvidia brought in $39.3 billion of free cash flow. When we divide that by their enterprise value, we still only get a 1.3% yield. Right now, it looks like Nvidia is priced even beyond perfection. The company would need to maintain a very high growth rate that would see them get even larger to justify today's valuations. That's why this is an X on metric number 6, our first and only of the day. Don't just go anywhere. You're going to want to see our next 2 valuations before you stay till Nvidia's fair value at the end of the video. Next, we'll use a discounted cash flow model to give Nvidia credit for its growth. We'll use their cash flows and historical assumptions to grow these into the future. In our valuation, we'll assume that Nvidia grows at 20% annually for the next 20 years. We'll also add in any tangible book value the company has to give them credit for their net worth. If we want a market-beating 15% rate of return, which is what Warren Buffett wants from his investments, even then at today's valuations, a DCF model only comes in at $52 per share. That's less than half of their current stock price, with the company being absolutely massive at the end of this 20-year period. This also assumes the same multiples. Even though Nvidia's been a very predictable business, it still looks like they're priced better than perfection. As we look at how the company trades compared to historical multiples and estimates for their future, our third valuation still only comes in at $94 per share. Now, Warren Buffett likes the numbers, but it's the qualities of a company that are his true love. Why don't we learn what these are for Nvidia through a long and a short thesis? We'll start with the long thesis first. Number 1, Nvidia's GPUs offer industry-leading parallel processing. This was historically needed in PC gaming, but has expanded into crypto mining, AI, and perhaps future applications too. Number 2, Nvidia's data center GPUs and CUDA software platform have established the company as the dominant vendor for AI model training. This use case should rise exponentially in the years ahead. Number 3, the firm has a first-mover advantage in the autonomous driving market that could lead to widespread adoption of its Drive PX self-driving platform. But things aren't all positives. Let's look at a short thesis as well. Number 1, Nvidia is a leading AI chip vendor today, but other powerful chip makers and tech titans are focused on in-house chip development. This includes chips from Amazon, Apple, and Meta. Number 2, CUDA is a leading in AI training and software tools today. However, leading cloud vendors would likely prefer to see greater competition in this space. They may shift to alternate open source tools if they were to arrive. Number 3, Nvidia's gaming GPU business has often seen boom or bust cycles based on PC demand, and more recently, cryptocurrency mining and AI. These boom and bust cycles are likely to continue into the future. Now it's time to put everything together for Nvidia. In our fundamental review, we learned Nvidia goes 5 for 6 on the Select 6 analysis. They earn extremely high returns and they've grown a ton in the last 5 years. However, this growth to become the world's biggest company comes amid supply constraints in the semiconductor market and very high demand. The demand for AI and cryptocurrency, along with autonomous driving, is going to have to be sustained for a long time for this to make sense, and Nvidia is going to have to be a far and away winner. Nvidia is a great company, but they have some very lofty expectations for their future. Their valuations are to the point where the math around the company just doesn't quite work out. Their past performance is great, but you need to ask yourself what sort of returns you can reasonably expect in the future. That's why when we look at our investing tools which show Nvidia's fair value, today it comes in at around $48 per share. That's just a third of their current stock price and way below street targets for the business. Today, Nvidia seems overvalued. To find stocks that are undervalued, sign up for our investing tools and get exclusive bonus coverage of 98 stocks and counting.